It's practically unknown for every blue chip share in a certain stock market to perform equally well at the same time. Participants normally favour a specific sector and neglect or ignore others. The two traditional categories of major share are defensive and cyclical shares. Defensive shares include supermarkets, consumer discretionary, financial services, and other companies of the old economy. These shares are usually somewhat less volatile than cyclical shares. In some cases, they can weather economic instability better as well. Cyclical shares comprise mainly technology, semiconductors, social media, software, and so on. Often, these shares are much more sensitive to trade disputes and economic problems, but they tend to make stronger gains during economic booms. Understanding which shares fit into which sector and when participants are switching focus between these two main sectors is a key question for many traders. Apart from charts and general news and sentiment, earnings season is a crucial factor in this. Every quarter, companies release financial reports. The primary focus of these reports for traders is on earnings per share, usually known as EPS for short. CFDs on shares don't pay dividends, but usually a good result for EPS is a positive factor for the price. Earnings season brings very high activity as companies release their reports and traders try to buy or sell quickly as markets price in the results. A singular advantage of trading CFDs on shares for experienced day traders is that it allows them to control larger positions around these times of strong movements. However, leverage in practice will also amplify any losses made by less experienced traders. Companies' future expectations can also drive prices. Hints can often be found in statements and announcements. Technology companies in particular tend to have flagship products that can significantly affect sentiment on their stocks. These products include Apple's smartphones and computers, AMD's mid-range gaming processors, Tesla's mass market models, and many other famous examples. Some traders watch the live streams of the releases of new versions of these products to gauge the response and the likely impact on the relevant company's bottom line. Much like trading earnings, this can be a risky approach, but for experienced traders, the large movements around important announcements and demonstrations can generate good opportunities.